Hello, this is Brian Resney, President of Resney Wealth Management, bringing you an important update about the economy and the investment markets. Well, we're firmly into 2022. We've seen the volatility that I talked about earlier in the year. And again, as I always stress, nobody likes volatility. It's normal and expected. I think we're going to continue to see this volatility. Not that the markets will necessarily go a lot lower, but I think we're going to see this up and down volatility at least until the second half of this year. I think as we get into the second half of the year, we're going to see inflation start to come down and abate, partially because of supply chain disruptions coming in easing. And generally speaking, the consumer overall is starting to slow their spending because they've spent a lot of the stimulus money that was pumped into the economy really from the Biden administration. So inflation still should start coming down second half of the year, but it will be higher than normal because, again, energy prices, as I talked earlier, will continue to stay high at least until the next administration. So plan on spending $4 or $5 per gallon for gas, at least for the next 2 to 2.5 years. And maybe at that point, things will kind of come down and ease. But inflation will come down probably to that 3% level once all the supply chain issues are really figured out, generally speaking. And again, the consumer doesn't have all kinds of crazy money that they were given to free by the government to spend, which really helped jack up inflation in addition to that. Volatility has always been here. Let me give you a few numbers. People talk about, oh my gosh, the market's down 12% year to date. Let's talk about that. Let's talk about the stock market down 12% year to date. What does that really mean? Remember we had COVID a few years back? The markets dropped over 30% in 3 weeks. 30% negative. And if you didn't do anything bad with your money and you were well positioned, we recouped those losses in our client portfolios and we went to new high ground and our clients had a fantastic year in 2020. And again, we didn't panic. We made subtle changes that would help boost, we felt, the overall portfolio to recover faster. And we've done some of those things of late, and we'll do more of those as necessary. But the market, down 12% year to date. Folks, 10 to 12% corrections happen every single year. Remember that. The problem is the news media. Markets are collapsing. Markets are down. Nobody will ever invest in the markets again. I love that kind of rhetoric because that tells me we're probably closer to a bottom than we were from the initial sell-off. But again, the stock market's down 12%. What about government treasuries, bonds? Wait, I thought bonds are the safest investment in the world. Government treasuries are down? Government treasuries, if you look at long-term treasuries, government treasuries 20 plus years, are down over 22%. 22%, almost double. Bonds are down almost double what the equity market is down. Is anybody talking about that? Imagine if your portfolio was all bonds and you're down 22% year to date versus maybe down 8 to 12% year to date. Again, there's different kinds of bonds. Bonds can have volatility just like the equity markets can, just like real estate, gold, oil. All assets will have volatility. Remember, investing is a process. I always look at the next 3 years plus. If I look at the next 3 years plus, I firmly believe things are going to be quite rosy and quite good. If I look at the next 6 months, expect volatility. And I talked about that at the beginning of this year, and we've been correct. We're back to normal volatility that we didn't see the last couple of years, but again, eventually it will abate. The U.S. economy is actually doing quite well. We are seeing some slowdown in certain areas, which is actually healthy, and that will help really reduce some of that inflationary pressures we do have. And the Fed is actually doing their job. A little late to the party, raising rates. I don't see a lot of interest rate increases. I see maybe 2 more 50% increases, and I think at that point they're going to be done. And again, I've talked about this before. I don't think we need to raise rates a lot because things are starting to abate. We're seeing that natural slowdown. So the Fed was really probably a year late in raising rates and really buying back these bonds in essence, or selling back these bonds that they stimulated the economy back in 2020 with. So the Fed's always usually a little bit late. Question is, are we going to have a recession? If we do have a recession, it will be mild at best. Again, the economy is quite strong. Balance sheets look pretty supportive, not only corporate, but personal. People are not in debt like they were back in, let's say, 2008 in the housing boom and bust. Whole different animal today. So what we're really seeing is a kind of a natural people overspent with money that really they would have never had. That's kind of abating because that money's been used up. And I think what we're going to see as we get into the second half of the year is really some opportunity to really not only upgrade positions, but really an opportunity for the U.S. economy maybe to actually have a little bit of a leg up before year end. So I still see positive signs ahead. But if, again, I look at the next 3 years, I see very good positive signs. In fact, when I look at interest rates right now and how much long bonds are actually down year to date compared to the equity market, there's actually some opportunities we're starting to look at, not invested in yet. We may make some adjustments to our bond positions in our portfolio for maybe a little bit longer to intermediate term bond exposure. But the bonds we currently own were the exact right bonds or bond investments to have in the portfolio, because some of those are down a little bit or nothing really year to date. If you have questions about your portfolio, as always, give the office a call. If you're a little nervous, give the office a call. Let's do a phone review. Let's talk on the phone or in office, whatever is best for you. And remember, our business grows from great clients like you. So if you do have any friends or family members that need a qualified, highly competent fee-only fiduciary money management firm, we always appreciate not only your business and your referrals. Have a safe and profitable day.